Robin Varzak is a contributor with Bloomberg Business Week. Good morning. Thanks very much for being with us.
Thank you, Steve. A pleasure.
I want to talk about a couple of pieces that you've written, but first of all, the president's quiet bull market. And you begin by saying, happy October, just dropping a line to say it's official. Your Reagan-era bull market has nothing on mine, so make no mistake, best be for Barack.
My editors let me get away with a little poetic license. That was just an example of how odd it is to think of Obama as having a better performing stock market than Ronald Reagan. After all, we're talking about the 80s, the decade of decadence, junk bond pirates, champagne wishes and caviar dreams, and here you have Obama just by dint of this quiet, epic bull market since the beginning of 2009 when he was sworn in, officially beating Ronald Reagan's as of a week ago.
Why?
You know, it's been very strange because never have you had unemployment so chronically high for so long, parallel to a stock market that has surged like this. Certainly when he took office, Obama, at the beginning of 2009, the conventional wisdom was that we were entering a period called the new normal of chronically high unemployment, of situations that are just, we're coming off the biggest economic crisis in a generation. It's going to be very hard for us to regain the millions of jobs, to restore balance sheets and payrolls. And yet, at the same time, the Bernanke Federal Reserve has kept interest rates at zero since December of 2008, supplements that with emergency measures north of $3.5 trillion, of quantitative easing, going out there and buying all manner of assets in order to smoke people out of the safety of cash and get them to buy stocks and real estate and condos in Miami. And that has really sluiced down to the stock market.
And that's really one of the big concerns because of this quantitative easing. Isn't that really the huge contributing factor to this bull market?
That's the read on Wall Street. After all, you can only keep interest rates so low for so long that people cry uncle. We saw it kind of recourse to real estate, which is really having a rebound. There are shortages in many markets right now. And after all, real estate led us into this great recession of ours. The stock market, amazingly, is up 188% since March 2009. And Obama really is not in any position out there to run on it, unlike the Clinton bull market where you saw everybody talking about equities, the dot-com boom. It got mentioned on The Sopranos. Camilla Soprano was an investor. This has really not penetrated the zeitgeist. In fact, people out there are decidedly more risk-averse than they've been in a generation. So on balance, it's been the most quiet bull market, I think, in memory. And
because of that, as you write, the president can boast on that. Is that because of the unemployment rate? Is that because of the overall mood of the country? What are the contributing factors?
All of the above. It's really difficult. If Wall Street is having a great time right now, Wall Street is coming off of a period of penance. It took TARP money. Mr. Obama inveighed against these bailouts and bonuses, and having to hold his nose to do what he did for AIG and Goldman Sachs, and Citigroup was pretty much nationalized, and Fannie Mae and Freddie Mac. And for these financial services firms to have really gotten their groove back, by some measures, their profits are at records again. It's really hard to go out there and say, well, I'm celebrating the investor class side of Wall Street, not the golden parachuted CEO class, which is going to have a great year for bonuses and for pay. So it's really hard to kind of dance on that line if you're the president and get political points out of it, especially when the economy still needs to recover more than 2 million jobs just to get back to the pre-crisis unemployment rate.
And that's what Ron says on this tweet, saying that high unemployment means we're all working 2 jobs for each person. Companies making more money equals higher stocks.
This has been a record period for the accumulation of cash. Companies have had it uniquely good. If you're a Fortune 500 company, you've been able to refinance your debt at record low rates. You've been able to go out in a yield-starved environment and put out 30-year debt at tiny, tiny rates because people are so starved for return, for interest. And that has not recourse yet to them hiring. They don't feel that in this environment that really that demand is high enough and consumers are eager enough for them to go out and justify investing in payroll, which really is what the economy needs.
Last week, Google broke the $1,000 a share stock, and you wrote a separate piece, Dismantle the Decrepit Dow. You write, the Dow Jones Industrial Average continues to be synonymous with the stock market. Its move will often kick off the nightly news, even though it has never been less representative of the real-time American economy. Can you explain?
With apologies to Charles Dow, the venerable founder of America's most quoted blue chip index. I mean, after all, I'm just a young whippersnapper. I have no business criticizing the methodology of this exchange. And yet, the most quoted, most celebrated index in the United States, if you watch the evening news and the Dow, it starts off with the Dow as a record. The Dow is nevertheless not included, perhaps the biggest success story, Apple. The other success story, Google, and because of its methodology that it cannot incorporate high-priced stocks, which a stock price itself should not mean anything. It should be the company's market capitalization as determined in the S&P 500. But had this Dow Jones Industrial Average, which is at a record right now, had it incorporated the likes of Apple and Google instead of some of these old world companies or these belated additions, the Dow would be far higher than it is today. So if anything, maybe the investor mood is understated, and I criticize the keepers of the Dow for their methodology, that they've robbed investor sentiment of this huge psychological plus.
You call Cisco as a performance drainer. You also refer to AIG, Bank of America, Hewlett-Packard, and Alcoa.
Yes, these companies were in the Dow until, I mean, Cisco is still in the Dow. AIG until its bailout was in the Dow. Alcoa was until a few weeks ago in the Dow, an old smokestacker. And instead of being able to bend their methodology to include the important likes of Apple and Google, they go and include Nike, Goldman Sachs, which is systemically important. Bank of America they included a few years ago, and they had to kick out because its stock price was too low. You know, this might all be just a tempest in a teapot, but in the end, could you imagine if we were able to say Dow 20,000 every night? And that would have been possible with some of these huge tech companies in the index, had the backers, had the index keepers, had the foresight and ability to put them in. And
Robin Farzad, why 30 in the Dow? Do you know?
It's just the way it was done. I believe there were 12 initially, and then that was up to 20 before the crash of 29. And then since the middle of the century, they thought that maybe they should up the number to 30 numbers in the index. It's a very strange thing. Visa was just added, and it and IBM have the most disproportionate weight on the Dow Jones Industrial Average. And they're good companies, but they're by no means as important as an Apple or a Google to what this economy does today in the real time.
And in the week ahead, a lot of focus on Twitter.
Everybody is talking about Twitter and the Statosphere and this IPO that's coming up. You guys know it very well, C-SPAN WJ. I've learned to know and love it myself. In the age of 140 characters, everybody has to hang a shingle on this medium, and it's become the essential way to broadcast news, to get news. The question is, how are they going to monetize all of this popularity? I mean, heck, it even helped foment nearly a revolution in Iran in the middle of 2009, and a lot of the scenes and a lot of the messages were transmitted over Twitter, and we saw it happen in Tahrir Square in Egypt. And it's a revolutionary product. It's going to have a gangbusters IPO. The question is, can this company make money? If you're a Google or if you're a Facebook, the lesson is that you IPO first and ask those questions later. So a lot of high hopes embedded.
Dave is joining us from Long Island, Democrats Line, with Robin Farzad, who writes for Bloomberg Business Week in one of his most recent columns on the president's quiet bull market. Good morning, Dave.
Hey, good morning, guys. I was just curious about, I know recently the Federal Reserve was talking about tapering and whatnot, and then the 10-year Treasury bond kind of spiked a little bit, almost close to 3%. But then I guess the Fed Reserve kind of panicked or whatever when they saw the interest rates shoot up. And they decide, oh, well, you know, I can't taper now and blah, blah, blah. Now, is this indicative of the Fed being trapped in a situation that it can never get out of? Like, so if it raises interest rates, it'll just collapse the whole, you know, Ponzi scheme situation that they created, or will they be able to get out of it? And it just, when you were talking about the Dow, isn't that odd? Isn't the Dow kind of like a leftover relic, kind of because it's an industrial index based on industrial? I mean, at this point, do we really have any industry left? I mean, isn't it all gone? Like in China and stuff.
We'll get a response. 2 points.
Well, on the Dow, it's called the Dow Jones Industrials, but it includes financial services companies, tech companies like Cisco and IBM, Visa, which it qualifies as at the nexus of technology and finance, old industrial smokestackers, GE, which is all of the above. So it is, to a certain respect, that you could cram that all into 30 components representative of the economy. On your other question, it's a very, very, very good point. If you'll notice, Chairman Bernanke gave testimony in late May, where he flicked at this idea of tapering some of the quantitative easing. Some of the extraordinary stimulus, I think it's on the order of $85 billion a month of purchases of Treasury and mortgage securities, which have been piled on in addition to keeping zero interest rates since December of 2008. That's the Fed's traditional lever of monetary policy. When he merely suggested that they could taper it towards the end of the year, the bond markets really felt a lot of hand-wringing during the summer. The stock markets experienced some volatility. Everybody started worrying about life with higher interest rates. And in the end, the economy wasn't strong enough, especially with the Federal Reserve from transition to Bernanke to Janet Yellen, for them to take away some of this stimulus. It is worrisome in that it shows that we're not even talking about increasing interest rates. We're talking about them pulling away some of the emergency. I mean, there was quantitative easing 1, quantitative easing 2. This is QE3, they call it. And at the mere hint of just taking back a little bit of that punch ball or calling closing time, the market really threw what was in hindsight called a taper tantrum over the summer. He has postponed that decision. The Fed came out this week, and they still see weakness in the economy. They still want to be at maximum stimulus in order to incent companies to actually go out there and hire people again. We haven't seen that happen. We've seen the money trickle down into stocks, into junk bonds, into real estate. It has yet to force itself, I think, in the thinking of companies where they're saying things are so good out there that we can't afford to not hire more people.
On the issue of Twitter, this is a tweet from one of our viewers saying, bingo, how does Twitter make money? Will it ever? I'm not sure, and sure won't buy at IPO prices.
Well, you have those promoted tweets. I mean, I get about 5 of them every day from the Olive Garden, which I don't know to what end or what they pay Twitter for, but it's unique in that it's a real-time way of jumping on things. If you notice that a college football game is trending and I don't know, your Buffalo Wild Wings or you're something that demographically really attaches onto that scene, then you advertise into that. It just shows how real-time advertising has become and how companies are demanding to keep their finger on the real-time pulse of the consumer and the media consumer. And the media subscriber, which frankly is on Twitter while he's watching college football games. This might be live tweeted right now on C-SPAN WJ. It's certainly a very robust and well-attended medium. So it's up to them how to monetize this. Is it banner ads? Is it conferences? Twitter just hired a head of news. Was Vivian Schiller, the former head of NPR, and she was for a while at NBC Universal. So they're trying, like LinkedIn, like Facebook, to have a hand in all these different pots.
Mike is joining us from Sun City, California. Republican line, good morning.
Good morning. You know, this President Obama, he's really, to me, he's really a secular socialist. He's more concerned with expanding government and the entitlements thereof than he is in promoting free market enterprise and capitalism. I think that's an indisputable reality. And that kind of segues nicely into, you know, the fact that he wants to redistribute wealth and so forth. I mean, this Obamacare is case in point. You know, America never asked for the government to take over 1/5 of the economy, the health care. And, you know, this is big government liberalism that's come full circle. And I don't think he realizes the pain. My point, my case, my deductible went from $500 to $9,000, and my premiums doubled. That's not the exception. That's the rule out here. Now, I know that so he and his policies and his political perspective, that's what is causing this nightmare. Now, I know he has the elite liberal media carrying water for him every day, and that's kind of sickening, especially given the pain in America right now. But because they don't care either. They help promote Obamacare without one Republican vote. But I really do think that in 2014, he's awoken a sleeping giant, and I do think that the American people are going to revolt against this big government intrusion. And it's real simple. The Republicans just have to tell them. It's a simple sales pitch. You just have to tell America that, hey, if you like Obamacare and the effects thereof of this big government program that's come full circle, big government liberalism, then you vote for the Democrats. If you want to repeal it and you want to get back to more, creating jobs and the priorities of the American people, which is exactly what America wants now. That's where they want its focus to be.
Okay, Mike, thanks very much for the call. A little bit off topic for this segment, but we appreciate the call and the comment, and let me take that point in terms of how you view it from Wall Street's perspective or the economy, the Affordable Care Act, what the caller was saying, and also what we could see in 2014?
On the elite liberal media, though, we should address that I wish I could be elite. I put in one dryer sheet in the dryer just like everybody else. On some days I might put in two, but on to that point. Wall Street and Washington, look at the disconnect right now. Indeed, you have a lot of people subscribing to this idea that Obamacare would be ruinous, that a trifecta of Democrats in Washington would plunder the budget. In fact, you've had divided government, a sequester, a debt ceiling, all this stuff kicked down the road, and at the same time Wall Street learns to live with it, and the S&P 500 surges. In fact, since we had our credit rating downgraded, the market is up massively. The bond market has done very well. There doesn't seem to be all of this concern about divided government. Even when we were on the 11th hour of the debt ceiling debacle and the government shutdown and the sequester happening, and lots of people in D.C. being taken out of the consumer class for several weeks. I mean, after all, they were temporarily unemployed. The market did not worry about it. The market, if we want to anthropomorphize it, seems to look past these things and is very kind of nonplussed by what's going on in D.C. right now. Having said that, 2014, is there going to be a shift toward more Democrats on the Hill? Are the Republicans going to feel the pain of these bad numbers in the polls that they feel right now with the Tea Party polling where it is? It's almost just a logical fallacy to think that only the defiantly pro-capitalist, pro-market Republican will get a good reaction in the markets. After all, George W. Bush took over when the stock market was in dot-com bubble territory, and it was deflating. And I believe the market under his watch was down 40%. Of course, it culminated in the meltdown of 2008, and you had what was looked at as a very friendly and amenable Securities and Exchange Commission, and it completely whiffed on the subprime disaster. So go figure that it's done a lot better under Obama and Clinton.
Our guest is a graduate of Princeton University, also Harvard Business School. He has written for the New York Times, the Boston Globe, the Wall Street Journal. He is now a contributor to Bloomberg Business Week, including his most recent column about the quiet Obama rally. Norma is joining us. This program carried live on the BBC Parliament channel in Great Britain. She's joining us from Hastings, England. Go ahead, please.
Hello?
Go ahead, Norma.
Hello?
Glad to hear from you again.
Am I on air?
You sure are.
I'd like to ask the gentleman a question about AIGFP, because I think the average person in this country wouldn't know. If you went out into the street and asked them what a bull and bear market are, they wouldn't know. And didn't AIGFP open in Britain by sidestepping tricky American banking laws? Because the ex-trader come author Scott Patterson said in his book, The Quants, exactly that they opened up in Britain in order to sidestep tricky American banking laws. And if that is the case, and the American taxpayer picked up the quantitative easing tab that AIGFP created, isn't there some anger across America that it was done here if what Scott Patterson claims is true? I don't quite understand it. Maybe the gentleman could explain what Scott Patterson meant. Thank
you, Norma.
Scott Patterson is a friend. He writes for the Wall Street Journal, and this book is actually a must-read in terms of what it digs up. AIG disaster and the subsequent cleanup. AIG's financial products unit was in fact based out of London, and there may have been some regulatory arbitrage and certain things that will fly in London that wouldn't fly in Manhattan, where AIG is headquartered. And London and Manhattan and New York City, I mean, they've always been duking it out for role of the globe's elite financial services epicenter. And so that may have been involved when things were frothy in the middle part of the last decade to get some units over to London. And you see that also with the Caribbean and certain companies that are domiciled in Bermuda. Nevertheless, there was a lot of anger originally with AIG. This was, in many respects, the most egregious bailout. The very definition of private profits and socialized risk. You had a company going out there and underwriting all of this risky behavior and being a codependent to other players on Wall Street, which it alleged it was taken advantage of, but it was an at-will participant in underwriting insurance policies that would blow up in its face in 2008. And who was on the hook for that when it became a systemic problem? Uncle Sam and the taxpayer. And AIG was bailed out numerous times. It had to go back to the trough again in 2009. That ship has been righted right now. AIG is churning out profits again. It's paying bonuses again. But a lot of the indignation was left back in 2008 and 2009. And ditto Goldman Sachs, Citigroup, some of the other players that were beneficiaries of TARP, Washington's $700 billion bailout package. AIG needed actual conservatorship, needed something on the order of $80 to $100 billion to rescue its bad assets. And that, by extension, rescued all of its counterparties that either dealt with it / treated it as a patsy. So yes, there was a lot of indignation, but let's not forget that a lot of this already happened 5 years ago. And this has been a long, drawn-out, lurid economic crisis and recovery, and people have gone on to thinking about more things.
Quick follow-up from your earlier point. This is a tweet from a viewer who says the Fed painted itself into a corner with quantitative easing, known as QE or QE2 or QE3, cannot stop without creating the mother of all bond market sell-offs.
It's a valid point. We don't know, especially in a transition where you're going from the Bernanke Federal Reserve to what is largely agreed to be the Janet Yellen Fed when she's confirmed. How are you going to, at this point, we're worried, considering the example of the taper tantrum, how are you going to first telegraph that we're going to have to withdraw some stimulus, and then actually withdraw that stimulus, go from $85 billion a month in quantitative easing to maybe $60 or $50 billion. And then the huge question, which they keep kicking down the road, is when are you actually going to increase interest rates, which have been at zero, at rock bottom levels for 5 years now? And how does the bond market process all of that? Some people out there might remember Chairman Volcker in the early 80s, who came in and had to battle inflation. And he really had to ratchet up interest rates in order to kill inflation to save the broader economy and set the stage for Ronald Reagan's Morning in America. There isn't any pressing inflation present in the economy right now if you believe the government numbers, but there's a lot of valid criticism out there that the Fed is swelling another bubble. This was a huge credit and real estate bubble that followed a stock market bubble in the last decade. And are we only repairing the exploded remnants of another bubble by swelling maybe the biggest bubble on record? And this is not just in the United States. You've seen great analysis that the Fed's largesse has extended to African countries, which are able to go out there and place sovereign debt at yields that they never could have imagined, because there's such a global appetite for yield and for risk, because rates have been this low for this long.
And another viewer saying we are now living in a jobless recovery, no hope, no jobs for the kids. Obama loves this dream, exclamation mark. Let's go next to Joe, who's joining us from Carmel, Indiana, Republican line. Good morning.
Yes, I want to associate myself with previous caller Mike, whose question I don't believe you answered. I think you're a great representative of Bloomberg Businessweek because you are part of the liberal elite media and you're very sophisticated flax for the Democrat Party line.
Well, Joe,
my question
hold on.
specific.
Joe, hold on a second. On that front, give me a specific example. How has he done that in your eyes?
Well, during this conversation, he is focused on, with tunnel vision, on the riverboat gamble, rather than the fact that you're on a riverboat and you have all sorts of vulnerabilities that he's finally getting around to them now, but he's not associating them with the Obama administration or the Democrats.
Okay, so
which
hold on.
They need to be associated with from back to FDR.
Okay, stay on the line. We'll give him a chance to respond, and then we'll follow up with your second point.
Was that a compliment? I don't know what to respond to. I just call them as I see them out there. I'm not in anyone's pocket. I have no vested interest in shilling for either Capitol Hill or the White House. And this has not been a black or white market or one that has cleaved toward Republican priorities or Democrat priorities. It's just one that has been largely controlled by the Federal Reserve. And after all, Ben Bernanke was a Republican appointee. And this has since kind of self-removed from partisanship. He's become somewhat of a nonpartisan figure. You have both sides of the aisle supporting emergency measures and listening to his every word when he offers testimony.
Joe, you
well,
want to
that's
follow
why
up?
the Tea Party. that's why the Tea Party is such a big, profound change in the Republican. Bernanke certainly would not have been a Tea Party opponent. But let me make my question very, very specific. You talked about Apple and Google being left out of the Dow Jones Industrial Average. Well, this comment probably applies much more to Google than it does to Apple. But Google is arguably in an extremely new business for which there is no track record that exists beyond 20 years, which is a very, very short time. Things like the NSA penetration of Google and Facebook could dramatically impact Apple's stock. I'm sorry, Google's stock. I'd be very interested in your comment as to whether you think it'll impact Apple anywhere nearly as much as it impacts Google.
It's a good question. Google is now the third most valuable company in the United States. It's worth more than Microsoft, which remains in the Dow Jones Industrial Average. It has disrupted my industry, magazine publishing. It has disrupted advertising writ large. It's changing media consumption habits. Google owns YouTube, where a lot of original content creation has moved to in a really profound way. And the market is telling you that it is more relevant than Microsoft, previously the world's most valuable company. So I don't think I'm making an objective call in that. I'm not making any call. That's what the market is saying in driving Google shares past $1,000. And this is a company that no one in the year 2000 had ever heard of, and suddenly it's the third most valuable company in the United States. Apple, there's that old line that the president had, what is it, a chicken in every pot, a Chevy in every garage. There is an Apple device in everybody's hands. I have several at home. You see college students having them. They're ubiquitous. The iPad tablet is single-handedly killing the PC industry. The iPhone reports more in profits than I think the majority of the S&P 500 companies do. This is the world's most valuable company by market capitalization, and yet it is not in the world's most quoted stock market index.
In terms of confidence and how people feel the country is going, I want to go back to something we asked our viewers earlier this morning. And if you're interested, you can go to facebook.com/CSPAN. We have reprinted this Gallup poll. And the question was really based on whether or not you feel you have an opportunity in this country. And as a way of comparison, let me share with you what Gallup found out back in 1952. On the same question, do you feel that there is not much of an opportunity or plenty of opportunity for growth in the country? In 1952, 8% said not much of an opportunity. 87% said there were plenty of opportunities. As a way of comparison to this year, the survey that was just completed late last month, not much of an opportunity, 43% adding to that number, 52% saying plenty of opportunity. So almost evenly divided, and this is what it looks like on our Facebook page, and I mention that because we got a comment from one of our viewers. Again, fewer Americans believe there is plenty of opportunity to get ahead. Don says, since Reagan, we have given the job cremators tax breaks and deregulated businesses. What have we gotten for our nation's investments? Our jobs shipped overseas, stagnant wages, vulture capitalism, health insurance unaffordable, out-of-control banks.
It's a demoralizing time if you are John Q. investor or John Q. public, mom and pop out there. You have a record number of college graduates living with their parents. You have a job market where people who've been employed and experienced for several decades even are taking apprenticeships and internships and part-time work, many of them working as baristas at Starbucks just to get health insurance. And never before in this lifetime have we experienced an economic shock of this caliber. Obviously, the comparison is made to the Great Depression constantly. And so it is a very demoralizing time. If you are, though, in corporate finance, if you're in Wall Street, it's been a great time for you. And you actually don't want to gloat about it, knowing how tough it is for everybody else in the United States. And that's the dichotomy and disconnect.
Patricia Meredith, just following up on that earlier Facebook comment, she says America lost its upward mobility when big businesses shipped our jobs overseas. That decimated a huge source of middle-class jobs. Let's go to Leonard, joining us from Hermitage, Tennessee. For Robin Farzad, who's joining us here in Washington from Bloomberg Business Week, his recent essay on the president's quiet bull market. Good morning, Leonard.
Yes, sir. John Boehner and Paul Ryan said 4 months ago that collecting taxes for the poor is stealing. And milk's supposed to go up to $8 a gallon. They don't farm bill, the Democratic farm bill. homeless shelters being shut down, public health clinics shut down, low-income housing not being funded, nursing home, Medicaid, Social Security, SSI, and Social Security all being cut. In 1996, 85 million people were below the poverty line. Now that makes about 100 million people now below the poverty line. Means 100 million people per year are going to die in the next 10 years because Republican cuts. If they take away, if they don't give anything to the poor, 100 million people a year are going to die from homelessness, lack of medicine, and surgery. Their children and their babies, people in nursing homes are going to be kicked out, and low-income housing funding is going to be cut. HUD is going to be shut down.
So, Leonard, do you want to take your assessment and turn it in the form of a question for our guest?
There's no way to question it.
Well, let me springboard off this point, because this week, one, there are a record number of Americans on food stamps in the wake of this economic crisis.
And they just saw their food stamp supplement cut last Friday.
Cut last Friday, by dint of an inability of Washington to come up with a more concrete agreement than just a temporary extension to the status quo to avoid the sequester. That is very real time. That is an immediate hit. If you're somebody who collected whatever, let's say $50 a week in benefits, and you're suddenly looking at $44 a week, and food prices are still creeping up, but that erodes your purchasing power. Your employment prospects are no better, and that's very real. But that is not any one party's fault, to my mind. I think that is by virtue of the fact that D.C. is operating on real stopgap measure right now. Everything is stopgap since the debt ceiling debacle, even after we had our credit rating downgraded. And in a previous life, D.C.'s profligacy and unwillingness to act and reunite in the old Graham-Rudman way would be punished by bondholders right now. They used to call them bond vigilantes. We saw them last in Spain and Portugal and Greece, and when they see an economy that's unsustainable and binging on credit and profligate, they go out and send their bond yields ever higher and make them cry uncle, make them find religion, make them go back to the public sector unions and demand cuts and espouse austerity. That hasn't happened in the United States because we are in the unique position of having the world's reserve currency and the primary readout of safety in the U.S. Treasury. When something goes wrong, even in the United States, global investors pile into treasuries and effectively bail us out. We would not be able to carry the kind of debt load and deficit spending we had right now if interest rates were 2 points higher than where they are now.
We welcome our listeners on C-SPAN Radio, our conversation with Robin Farzad as we talk about Wall Street, the economy, and a recent essay he wrote for Bloomberg Businessweek, The President's Quiet Bull Market. Let me share with you 2 tweets dealing with this market and some historical analysis. This is from Greg, who lives in Sioux Falls, South Dakota. He says, comparing this market to the 1926-29 market, in your opinion, is this a massive bubble?
Well, I was there in 26, and it was a rough time. No. I love The Great Gatsby, but this is being compared to bubble markets, certainly. It's obviously a much more evolved economy and market and regulatory system than it was in the Roaring '20s. And nowhere did you have the Federal Reserve doing anything like it was doing in its infancy in the Roaring '20s and the Gilded Age. This is a real-time kind of winged experiment going on. The Federal Reserve, at zero interest rate policy for 5 years, having thrown nearly $4 trillion of conjured up money into buying assets in order to stoke an appetite for risk-taking. How do you unwind that? How do you reverse that? There's no precedent in history for us to look back at evenly. I mentioned Paul Volcker before. He was ratcheting up rates to deal with a host of other issues that the country and economy dealt with in the dreary 1970s and early 80s. There's no neat analog, and this is worrisome in that you're going to have a new person, Janet Yellen, taking over the Federal Reserve come next year. And if the economy and market keep gaining, the Fed at the very outset will have to come out and more concretely telegraph how and when it is going to withdraw this stimulus. And I can't imagine the first day when they actually hike interest rates after all these years, how the market is going to process that, because you have a very compelling argument that there's a codependency right now. We've learned to subsist only when and if there are record low interest rates.
Do you see any potential roadblocks in the Senate confirmation process for Janet Yellen?
I think there'll be people out there that ask tough questions. The Tea Party contingent certainly is out there saying that we can't just be printing money, and the Federal Reserve must be more vigilant about this kind of deficit spending, and you need to browbeat Congress more and exert your moral suasion. So I think they will give her a rough time, but there is pretty much, I sense some unanimity that she is going to be the next Federal Reserve Chairman, and she's a very esteemed vice chair right now, and she's been simpatico with the record low policies. So the conventional wisdom is that that's going to continue for the foreseeable future.
This is from Lou, who describes himself as a Democrat. He lives in Highland Park, Illinois. Stock market rising, question mark, he writes. How much of the stock market performance is due to the companies borrowing at extremely low rates and using that money to purchase their own shares, and how much monetary easing money actually found its way into the economy?
It's a great question. Not just share buybacks, but how much of these companies are enjoying ridiculously low interest rates. A company like McDonald's that can go out and place 30-year debt for a little over 3%, or a Caterpillar or a John Deere, it's ridiculously good. Imagine being able to go out and borrow money for 30 years at 3.5 points or a little less than 4 points, which people have been doing in housing with the mortgage market until recently. And if you are creditworthy and you can do that, then the idea is you're going to get the last laugh, because a lot of things can happen in 30 years. Inflation can spike, the value of that debt can get inflated down, eaten down, and so companies that are very creditworthy, that are taking advantage of a record bond market, corporate bond market, are availing themselves of this. And they also see this with stock buybacks. If you can borrow money on ridiculously cheap terms, as Apple did recently, and you can buy back a slug of your stock, which you perceive to be undervalued, then you are engaging in some sort of arbitrage that will be to the benefit of your shareholders after a period where your bondholders have had it uniquely good. I mean, never have junk bond investors had it this good. Never has that market been as sanguine as it is now, not even in the era of Ivan Boesky and Michael Milken. And you wouldn't typically associate that with the Obama administration, not that it's of their own creation, but this crisis was so deep that the measures necessary were of such urgency and emergency nature that that kind of rising tide of liquidity has been lifting all sorts of boats.
Joe makes this point on our Twitter page. Yes, another tweet. This is from Joe Farnarkle, who says the largest problem facing the U.S. economy is government interference and cronyism. We've got Adam next, Stamford, Connecticut, on the Republican line for Robin Farzad of Bloomberg Business Week. Good morning, Adam.
Hi, good morning. How are you?
Fine, thank you.
Yes, I'd like to talk about the numbers of the Dow, especially around 15.5 or so. I was just wondering, how come the media really isn't reporting that, adjusted for inflation, the Dow is at about 1999, 2000 levels?
You're right, and it's a very good point. The fallacy that a lot of investors make is they don't look at things in inflation-adjusted terms. The broader market had only round-tripped back to Y2K levels recently. And when adjusted for inflation, if you look at 2.5 or 3%, little less than 3% inflation over the past 13 years, you've been down as an investor in the stock market. I just don't know why it's not reported more in inflation-adjusted terms. And ditto with oil prices. You talk about the oil shock in the early 70s and in the wake of the Iran hostage crisis and oil prices. It would be a lot more helpful if more of my peers reported this in apples-to-apples inflation-adjusted terms.
Next is Lisa from Windsor Mill, Maryland. Good morning. Welcome to the program.
Yes, hi. I wanted to ask, when will the whole system collapse because of all the illegal activities, fraud, and credit derivative swapping that occurred on Wall Street? To me, it's just all smoke and mirrors. And how can we be into debt trillions of dollars to China, a communist nation whom we're supposed to hate? I just don't get that. And then how could not one bankster go to prison for all this illegal activity that they've done? First, they were too big to fail. Then recently I've heard they're too big to indict. I've never heard of such. And they've created all this pain on Main Street. I just think it's disgusting, and I keep praying every day for all of them to be lined up, the politicians right there behind them.
Lisa, thanks for the call. Your thoughts?
Where should I start? Let's take China. Walmart is China's 6th largest trading partner, if Walmart were to be a nation unto its own right. And there's a codependency between the United States and China. The guest earlier talked about all the jobs that have been outsourced and offshored. The benefit, the rebate, so to speak, that you get from that is being able to walk into a Walmart or a Target as an American consumer and buy a DVD player for $25, or to get any sort of apparel from places like Bangladesh or Cambodia or Colombia that are much cheaper to manufacture than they would had these jobs been kept in the United States. Obviously, there's been no shortage of hemorrhaging of manufacturing jobs for the past 15, 20 years. You talk about NAFTA, you talk about China's entry into the WTO. This has largely continued unabated, but what it has, I think, affirmed more than any other time in history is how intertwined our economies are. The Chinese, for example, could have been those bond vigilantes. They like to go out there and inveigh against the excesses of Congress and the White House and the recklessness of things like the budget showdown and shutting down the government. But they can't turn around and not buy government debt to punish this kind of profligacy, because that would then be felt by the American consumer, who would not be buying more products made in China. And then the government of China suddenly is imperiled because people there are racing from the countryside to factories to keep jobs. So you have this whole Rube Goldberg type setup. And no one is in any position to kind of go out there and say, no, we don't like you, no, you are bad. You just don't want to rock the boat. On the question of penalties for Wall Street executives, this is a topic of much pungent indignation when I go out there and report stories. I think, in short, let's just take the cynical perspective. It was the perfect crime. If you believe it was a crime to go out there and take private profits and this kind of risk-taking with socialized risk, it happened under the nose of the SEC. It happened under the nose of a presidential administration. You have Wall Street executives that were brought before Congress that said, we screwed up. We were extending loans to people. We were making mortgages because we thought the housing market wouldn't fall. And after all, this is the American dream. We're not guilty of any fraud. We're just guilty of messing up. So it's not my problem. And so those bonuses weren't clawed back. Certainly nobody was thrown in jail. The head of AIG's financial products unit got to keep all the money he made. They came out and said that we just whiffed. Private profit, socialized risk was the legacy there. And I think that on balance it was looked at as too complex, as too much of a bruising battle for the White House or Congress in 2009 to actually go out there and perp walk certain executives, people who were in charge of Lehman Brothers, Bear Stearns, AIG.
We have about a half minute left, but I want to go back to your piece, which is one of the reasons we invited you to come on to talk about the president's quiet bull market. And there's a quote in your piece. You mentioned that the market is amped up, but the impact on Main Street has been modest.
I don't think you've ever had a bull market run of this size. It's up 188% from the low in March of 2009, accompanied by Americans taking money out of the stock market in record numbers. I think more than $400 billion has been taken out of equity funds in the past 4 or 5 years. People are really disaffected, really heartbroken, really disgusted by what happened in 2008, especially after they got their hearts broken in the dot-com bubble, and they said never again. And only now, hesitatingly, are they belatedly coming back to the stock market. And tragically, it's yet another example of sell low, buy high.
Robin Farzad, Bloomberg Business Week. Thanks very much for being with us. We appreciate it.
Steve, my pleasure. Have a great one.
Please come back again.
Thanks.